Hi, everyone. Thanks for joining today. We're just giving another 2 or 3 minutes before we begin, so hang tight. Thank you. All right, looks like we can get started. Um, hi, everyone. Thanks for joining today's PPP Loan Forgiveness and Reopening Guidance for the Restaurant Industry webinar. Today's program will be presented by Mary Lou Halverson from the New Jersey Restaurant and Hospitality Association and Dan Mayo from Withum. Before we begin, I just have a few housekeeping notes. Materials for today's presentation can be found in the toolbar located to the right of your screen. Also at the bottom of your toolbar, you'll see a question box. All questions pertaining to the webinar content will be answered at the end. We'll do our best to address them. We'll be emailing out a copy of the recording and slide deck at the end of the presentation. And finally, once the webinar is over, there'll be a pop-up box asking you to complete a survey for today's webinar. Please take a moment to complete it as our best way of being able to provide you the best and most relevant information possible. So with that, I'm going to turn this over to Glenn Bellamy, the practice leader of our Withum Consumer Products Group.
Okay, so good afternoon, everyone. Thanks again for joining us for today's webinar. These continue to be difficult times for the restaurant and hospitality industries. We're hoping that we will get back to normalcy soon. Today, as Ilana said, we have Dan Mayo from Withum, who's really done a great job of learning the SBA rules and regulations. And he will speak about the forgiveness procedures on the PPP loan. I'm sure most of you know that the SBA came out with their forgiveness application on Friday. So I guess let the games begin. So very interesting times. Also, we have Mary Lou Halverson, who is the executive director of the New Jersey Restaurant and Hospitality Association, and she will speak about the reopening guidance of restaurants. Also on the call is Kathy Innes, who is a partner with Withum in our Florida office. She's experiencing some of the openings in restaurant. As you know, Florida's opened up some of the restaurants, and she's given us some good insight on what they're going through in their phase 1 or phase 2. Also joining us from Withum is Terry Moncrief, who is a team leader in the food and beverage group. So again, I guess why don't we get started? Mary Lou will get us started with the guidance on reopening. Every day is a different, it changes every day, so it's a moving target. So with that, Mary Lou, why don't you begin your presentation and let us know what to expect.
Oh, there we go. So thank you so much, Glenn, for having me and everyone out there. So obviously, you know, we're looking at, and everyone's wondering, when can restaurants open? And, you know, I wish I had an answer for you. Today, the governor came out with an announcement about a phased-in approach, which we kind of knew was going to happen. What's a little disappointing is that there's no dates attributed to this phase-in. So we're in phase one, which is takeout and delivery. And then phase two will involve outdoor dining and limited capacity. And then phase three will be regular indoor dining, although still with social distancing. What is concerning, as I said, is that there's no dates attributed to any of this. And for all of you restaurateurs or hotel owners, you know that you need notice. You can't just open your doors tomorrow. So that is even, you know, almost as important as when you can open is getting notice about when you can open. There's been a few things that we obviously have been asking, and we did get the cocktail to go, which is kind of it's a good win. We're working on getting liquor license expanded, because as we look at reduced capacity for restaurants, we're going to be able to see where can we use outdoor spacing and things like sidewalks, parking lots, town parks. So we're working with the ABC and the League of Municipalities to help towns know how they can safely allow restaurants to use some public spacing for that. So that's going to be kind of the phased-in approach. We had submitted to the governor's office 4 plans. One is our safe dining, which is for restaurants, safe stay for hotels, safe celebration for our wedding and banquet venues, and safe play, which is the amusement parks. So the governor and every member of the legislature have these plans. They're here in your attachment, and basically it just addresses what we all know is that outside of healthcare, nobody knows how to do sanitation better than the restaurant and hotel industry. It's something, you know, we live and breathe every day. But this actually just takes it a step up, because we want to make sure that we're giving not just the governor's office, but we're giving our employees and our customers confidence to come back into the restaurants. So the plan is basically outlines what we're going to do in each of those phases. And again, I won't go through it because you guys can all read that. But if you do have any questions about that, please, you know, let me know. We also created what is called our industry promise, and it's really just our commitment to both our customers and employees on what we're going to do to keep them safe when they walk back in. And so that we're going to be asked, that will be posted outside of every restaurant or hospitality business. We are creating a video that you'll all be able to use and promote. And it's just to educate people on what will it be like when you first walk back into a restaurant. So you're going to walk in the door, and what is that going to look like? You know, you're going to be looking at disposable menus or personal condiments. The host probably will have a mask on. You may ask not to congregate, obviously, in the lobby area, but to go wait outside or wait in your car. When you sit down, you know, how is that going to happen? How are you going to be paying? Because we want to make sure that when customers come back in, they're not taken back by their server wearing a mask, which we know this governor says he loves masks. So we're pretty sure that's going to be part of any plan we have, is you're going to have to get your masks. We're hoping that this video will help alleviate some of that anxiety of what the consumer will feel. So we're doing many different things. We actually will be doing a call to action to encourage the governor that phase 2 needs to happen soon, because again, you all know how to do sanitation very well. You're better at it than any other business. And if they can open non-essential retail, they can certainly open, you know, the restaurants. So, I mean, that's really it for me. I could go through the plan, but I think you all know how to read. What I do ask is if you have any questions, you certainly can email me. Is it all right, Terry? Glenn, if I give my email address, it's mhalvorsen, HALVORSEN @njrha.org, or my number is 732-779-4090. Our office is closed, but our team is working remotely. And the other thing, just to let you know, is that for ServSafe, everybody is going to have food handler, which, as you all know, you have to have a ServSafe manager, which that will remain, the same, but now everybody will need to have food handler. It's a quick course, but it's really geared towards just high sanitation methods, and that's going to be for your servers and your bartenders and probably food runners and dishwashers. And right now it's being offered free through the end of May, May 30th. So it's, if you go to the National Restaurant Education, the National Restaurant Association, and go to Solutions and their ServSafe tab, and you can click on Food Handler, and it's free in English and in Spanish. So for whatever staff you do have on, if you're operating, take advantage of that now, and then we will be offering it as well. We are trying to get a grant so that we can offer it to all of you for free in the future. So that's it for me, unless there's any questions.
Okay. Thanks, Mary Lou. I just have one or two questions. And so are we anticipating restaurants to use their own forks and knives, or is it all going to be a plastic situation to start? Any discussion about that?
No, there's talk about wrapped utensils, some sort of temporary table covering. So whether it's butcher block, I heard someone in the governor's office say, what about linens? And then you can wash them all the time. I don't need to tell you what a nightmare that would be for a restaurant. I mean, if you have linens, you're used to doing it. But, I think butcher block, or just highly sanitizing those touch points of like your tables and your chairs, obviously, and making anything else as disposable as possible. But I don't think we're going to see disposable plates or disposable utensils. I mean, that might work for some people on the webinar today that are already doing that. But the way that we clean with cleaning detergents and high temperature water, you're going to kill anything.
Mm-hmm.
We kill, just to touch it, get a little technical. I mean, we know how to kill norovirus, which is harder to kill than the coronavirus, because the norovirus is encapsulated, and it's hard to break through on that, whereas the coronavirus is not encapsulated. So it's easier to kill than norovirus.
Okay, oh, that's great. Do you vision patrons wearing masks as they walk in and while they're sitting down? It's puzzling to see, that what's the atmosphere going to be like, Well,
we did advocate for not having consumers wear masks for two reasons. One, you can't eat and wear a mask. I mean, it's that's a little challenging. Perhaps when they walk in and they sit to their table and then they can remove their mask, I can see that they're probably asking for that. But our more concern is requiring our back of house, or those people that are working on the grill or the stove cannot wear masks. It's dangerous for them. So that is just, can happen. But more or less, you'll see the customer facing staff wearing masks.
Mm-hmm. Okay. All right. Well, I guess stay tuned for a lot of changes coming down the pike, and we'll see what happens with the governor and opening phase 2 and phase 3 and so on. Hopefully we get back to some normalcy for the summer, because it's critical for, this is where, the shore makes all their money, is during this time period. So let's hope we can get back to normalcy. So
we're doing a call to action. I mean, we sent one out, but we are encouraging everybody to call the governor's office and, let them know we can do outdoor seating safely. We can do limited capacity safely. We know how to do it. And we are the state's largest private sector employer. So if you think about that, so many of the people on unemployment right now are probably some way related to the hospitality industry. We get that industry back up and running. It makes great financial sense to the state, because that would get people off unemployment. And I know we need to worry about the health and well-being of our residents first, but we do need to worry about job security and people feeding their families.
Yeah, makes a lot of sense. Well, thank you, Mary Lou. I appreciate your words, and we look forward to hearing from you through either your emails or other communication to let us know about phase 2.
Thank you.
So with that, why don't we move on to another topic that's very important to everybody that's on the call is the PPP loan. And Dan's been living and breathing this for the last, I don't know, 50
Since
days.
March 27th, yeah.
So it's been crazy. A lot of changes daily. They come out daily. So we all know that like I mentioned before, the SBA has released their application. So like I said, that let the games begin. It doesn't look like it's too bad of an application process, but we still need to make sure that our I's are dotted, T's are crossed. I do hear, watching the news that, unfortunately, the PPP loan, and Mary Lou and I discussed this, is that it's not all that great for the restaurant group, right? Because a lot of your employees don't want to come back to work. I mean, you guys are shut down. Maybe it's good for liquidity later on when you bring people back. But I do hear anecdotally that, they are going to do something with restaurants in the PPP loan. Nothing definitive yet, but hopefully they'll make some changes there and expand the uses for these funds and the forgiveness. So with that, Dan, why don't you jump in and talk about the forgiveness process, and we'll go from there.
Sure, thanks, Len, and happy to be here today. So we're going to start with, I thought we'd start with this SBA's Inspector General's report talking about the implementation of the PPP through May 8th, 2020. So you turn the next slide, please. So what's interesting about this is it shows, look at table 1 first, and this is the loans that were made from round 1, the first phase, right, before they refunded it. It refunded the program. They made 1.6 million loans for a total of $342 billion, and there are almost 5,000 lenders involved in the program. When you get to the round 2 now, which is not fully exhausted, you already have, just looking down the approved loans, you're already at 2.4 million loans, and the total amount of them is 183. I think they approved 310 billion in round 2, so there's still a lot of capacity left. And on the right-hand side, I want to put it in perspective, just the size of the program relative to what the SBA does in a normal year. And so if you read that quote, it says, before the PPP, the largest single year of this 7A lending program, that's the same program as the PPP, was approximately 25 billion in fiscal year 2017. And just looking at the PPP, they've already approved 4.1 million loans totaling more than $525 billion, more than 20 times the largest year in the SBA's history has been loaned in just 33 days. So it's been an amazing scale. And if anyone's frustrated with the program, this is the reason why. The loans have been delayed, the applications have been delayed. They just weren't set up for this kind of capacity and onslaught that they've received. So anyway, I thought this was interesting to put it in perspective first. The next slide, please. So now we'll talk about loan forgiveness, which is the topic on everyone's mind. Anyone who's received a loan, as soon as it's almost like I joke with people that the day you get engaged, everyone says to you, when are you getting married? And the day you get married, everyone says to you, when are you having kids? And so the day you get your loan, the next question is, how do I deal with the forgiveness aspect? And so that's what we're going to talk about today. As Glenn mentioned, the application came out late Friday night. It's an 11-page application. There's 4 parts to it, 2 of which will be submitted to the bank, and one, there's an application and a Schedule A, which will be submitted to the lender, from the borrower to the lender. That's the forgiveness application and Schedule A. There's a Schedule A worksheet, which the borrower will complete but not submit to the lender. And then there's a demographics form, which is optional. If the borrower wants to complete it, they can submit it. If not, it's not necessary to complete it. The SBA does require borrowers maintain this documentation for 6 years from the date of forgiveness or the date that the loan is repaid. So potentially up to 8 years. They'll have to maintain all their documentation. And then, so there's been a lot of, as part of the new formula to calculate forgiveness, we've learned a lot of new information about some definitions, about what how they're interpreting certain provisions of the CARES Act, and we've also seen what the calculation will be. So these slides unfortunately don't account for that. So I'm going to try and weave into the best I can what we've learned from the application into this. I think I have 2 or 3 slides. I tried to keep the slides very short. So first, forgiveness. The statute talks about costs incurred and payments made in the 8-week period. Nobody knew if this meant and or if it was an or. And the SBA has come out and it said it means or. They're talking about it implies to costs that are paid, well, costs incurred during the 8-week period or payments that are made during the 8-week period. And so the way this works, it's somewhat asymmetrical because they allow, if a payment is made on the 2nd day of the 8-week period, for example, for payroll, and it covers payroll for the 2-week period before the 8-week period, then that will be covered. That will be included in the forgiveness amount, even though the amounts were incurred before the 8-week period, right? The covered period. And so it all on the back end, it does not include payments made after the 8-week period unless it's an ordinary course payment. So, for example, if let's say a biweekly payroll and the payment's made at the end of week 7, and then there's no payment at the end of week 8, it would be paid at the end of week 9. Week 8 can be included in the forgiveness amount as long as it's paid in the ordinary course in week 9. Week 9 would not be included though because it's outside the 8-week period. So it allows for, that's where the incurred comes in. That 8th week is incurred and it's included even though it's not paid until the end of week 9. But on the paid side, it allows for, you can't make prepayments, but it allows for back payments, payments relating to periods before the 8-week period. Of course, for payroll, this is still capped at the $15,385 for any one person, plus the benefits and the state taxes and the group healthcare costs. So that's how they interpreted that. In terms of when the application will be submitted, that's not clear, but there was an odd statement on the application. They put an expiration date on the statute as if it was a carton of eggs or something. And the expiration date is, I got one laugh out of that one. That's good. The expiration date was October 31st, 2020. So to me, I think what they're saying there is that's the end of the application period. And we I'm sure they'll give guidance in the future as to what that actually means. But I think that what they're suggesting there is all applications will be due to the lender by October 31st. And then the lender has 60 days to complete its application. For those, if for any restaurants or hotels that are open and paying employees, and they are engaging in the payroll tax deferral, the employer payroll tax deferral, it might make sense to delay the application as late as possible, because once you receive forgiveness on a loan, you can no longer defer the employer's FICA portion, the 6.2% of it anyway. You can no longer defer that after once you receive a decision on the forgiveness application. So if you can delay that application to October 31st and the bank takes 60 days, you can maximize that employer payroll tax deferral along with the loan forgiveness on your PPP. So just a little planning suggestion there. There are 4 limitations on the loan forgiveness amount. And the last 2, the principal amount of the loan plus accrued interest, that stays the same. And no more than 25% can relate to the overhead or the non-payroll costs. That they retained that in the application process. And those 2 come in at the end of the calculation. They come in at the very end. And the key guidance that was provided was in the headcount reductions and the wage reductions and how those 2 amounts are calculated, how to calculate FTE. And so we'll start with the headcount reduction. The FTE or full-time equivalency determination is made on a weekly basis, an average weekly basis. So recall that you're comparing the average full-time equivalency of the base period, which is either mid-February to end of June of 2019, or January to February of 2020. That's your one of those two base periods against the covered period, which is the 8-week period after you get the loan. So we're comparing those two periods, and then there's slightly more complication, but the way the FTE works, it's not a 30-hour concept as many people had assumed, and as we'd seen in prior SBA guidance and slides that were online, which is where the 30 hours came from, also from the income tax rules. It's a 40-hour determination, and there's two tests that they allow that to be made. And so one is what I call the base method, and then right there in the base method, they say for every employee, you take the number of hours, divide by 40, and cap every employee at 1 hour. So if you have, let's say you have 3 employees who work 10 hours, 40 hours, and 50 hours, the 40 hours is going to be capped at 1 person, the 50-hour person's capped at 1 person, and the 10-hour person, 10 over 40 is 25%. You round it to the nearest 10, so that's 0.3. So that would be 2.3 in that example. The simplified method takes you look at every employee who works more than 40 hours, 40 or more, and that counts as 1 FTE, and every other employee gets assigned a 0.5. They're half an FTE. So you don't need to get into the exact number of hours. It's either part-time or full-time. Part-time or 0.5, full-time or 1, and if they're 40 hours or more. And so that's the simplified method. They do require you use the same method on both sides of your calculation, so it's a apples to apples comparison. And at least initially, we think there's a way to. I think it's going to make sense for borrowers to do the calculation both ways, because there is an advantage if you have your employee hours, your part-time employees rather, if they go up in the covered period relative to the the base periods. We think you're going to be better using, if the numbers go up, you're going to be better using that base method, because you can get an increased number for your employees. You can get 0.78, 0.7, 0.8, and 0.9 for your FTEs to increase the number, so there's no reduction in forgiveness. If you have a net reduction in hours of your part-time employees, we think it's going to make sense to use the simplified method, because everyone's getting a 0.5. So if an employee went from 0.9 FTE to 0.1 FTE, there'll be no reduction using the simplified method, because you're going to be at 0.5 in both cases. So there wouldn't be in the aggregate, they're less likely to have a reduction in forgiveness. So there is a difference between the two methods, and there are instances where you would choose one over the other. So we do advise calculating it under both methods. There's elimination of the headcount and wage reductions, the rehire rule. And this is a quirky rule that talks about, you have this window period here, February 15th to April 26th. And the way this works is if there are any eliminations or reductions in force during that window period of February to April, and those people are restored or rehired by June 30th, then you can ignore the reduction that occurred during that window period. And the application makes clear that you take a snapshot approach. So they're looking at literally the day of June 30th, and is the person rehired by June 30th? Doesn't matter if they were rehired at 11:59 p.m. on June 30th. As long as they were there on June 30th, they are considered an employee. The rule doesn't even require that they be employed on July 1st. So even though that is the literal application of the rule, we do recommend a substance over form approach, in that we don't recommend hiring someone for one day thinking that it'll reduce your or eliminate your reduction in forgiveness. And the same thing applies with the wage rule. As long as the wages are restored by June 30th, even if it's outside your 8-week period, which is a strange application of the rule, but that's the way it's written. If you restore the wages, you won't suffer the wage reduction. Again, even if you didn't pay them before June 30th or don't pay them after. So it is a quirky rule. The SBA did issue this FAQ 40. It seems like ages ago, but it's really 2 weeks ago. That talks about, and this is a big thing for the restaurant industry, when they lay off employees, they then told the employee, we want you to come back. And the employee says, no, I'm making more money on unemployment. I'd rather not come back. So in this case, there's a special rule that says the employee will not suffer a reduction in forgiveness if they give a written offer to the employee at the same wage the employee declines the offer and the employer documents that the fact that the employee refused to come back to work. So that rule's there. The FAQ has been out there, but the application expands upon that, and it allows for 3 other reductions. And one is where the employee was fired for cause. The other is where the employee voluntarily resigns or quits. And the third is when the employee voluntarily reduces their hours or requests a reduction of their hours. In those 3 additional instances, the employer will not suffer a reduction in forgiveness relating to those 3 things. We do know that the amount forgiven is tax-free, so the borrower will not pay income tax on the debt forgiveness. Normally, that is taxable under the Internal Revenue Code. The CARES Act says it is tax-free. The IRS then issued a notice saying that the employer, however, will not receive a deduction for the expenses that it pays with those forgiven funds. And so they're trying to say here that the economics are that the government's paying these expenses, right? The money's going from the government to the employer to the employee or the overhead, and therefore the employer did not really pay it economically. So the tax then matches the economics, because if there's no income and no deduction, the employer is flat, much like the economics of it, where they're also flat. There is a lot of discussion in the legislative circles and proposals to change this and to restore that deduction for the expenses that are paid with forgiven funds. So that is out there, that legislative proposal. Go to the next slide, please.
So Dan, just a quick question.
Yeah.
That's a pretty significant item for a lot of people. You know, if you get a $2 million loan and you use that loan for, you know, qualified expenses, you know, you really have a $2 million taxable item, right?
Yes.
Correct?
Yep. So what's going to happen is you're going to have $2 million of income, right, from revenue, $2 million of income, and you're not going to have any deduction for those expenses because you lose them. So you're going to have a large tax bill relating to the income, even though the forgiveness itself was tax-free.
Yeah. So that's a little bit of a whammy to you know, all these entities as well.
Yes, and I think that's part of the reason they're looking to restore the deduction, is because they realize people are going to be hit with a big tax bill now that is unexpected.
Yeah, that could be significant.
Yeah, I mean, when the IRS issued that notice, I don't think they were concerned about the impact on borrowers. They were saying from a technical point of view, there's this code section 265, and that applies to deny the deduction, and that's all they cared about. They're not concerned about policy and about you know, the impact on the borrower. That's for the legislature to take up, and so that's what they're talking about doing now.
Okay, thanks.
Sure. And so when we look at the other things that were done in the PPP application, so the paid or incurred is the big one. There is a box to check on the application for loans over 2 million. And presumably that is to flag the SBA review process, where they said in the FAQ, in their frequently asked questions, that they're going to review all loans over $2 million before forgiveness is granted. So if you have one of those large loans, they're committing, I don't know if they're actually going to do it, but the SBA is committed to reviewing these loans before the forgiveness decision is made by the lender. And so that box, checking that box, will presumably flag the application for that review process. Let's see, talk about the group healthcare side. They define the group healthcare benefits slightly just by saying that that's part of payroll costs, that it includes employer contributions to self-insured employer-sponsored group health plans. So for the larger restaurants, that will be the where the cost comes in, and the payroll cost, and that can be as a forgivable expense. And then finally, we'll talk about before we open it up to questions, the certifications that the borrower is required to make and the documentation requirements. And on the certification side, the application includes 7 certifications. Each one is required to be initialed separately. So we know that they really care about them and that they want borrowers to focus on them when they sign them, because they are signed under penalties of perjury. It's given to a federal lending institution, which makes it a crime if it's a willfully false statement. And so they want that acknowledged on the application. And there are acknowledgments that, you know, false statements can lead to criminal prosecution. But what we're really focusing on with clients is not that situation. It's that they want clients to verify that the amount of payroll and non-payroll costs listed on the forgiveness application are true, accurate, and complete, and that the borrower investigated those costs and that they believe the amounts submitted to the lender are accurate. So they're putting the borrower on the hook, and they're letting the borrower know that it's not enough to just estimate these numbers or to put false numbers. You're certifying that you've checked your documentation and that the numbers you submitted are accurate. The borrower is also certifying that the loan was used for authorized purposes, that the allowable uses of the loan were maintained. For example, the borrower did not take the money and go, buy furniture for the restaurant. And so that would not be a permitted use of the loan. And that's one of the reasons we were recommending to clients that they keep the funds in a separate account. And so it's not necessary, it's not required by the statute, but we do recommend it so borrowers can trace the funds and how the PPP funds and how they were used. And so if the borrower can show that its funds were used for payroll and for rent, mortgages, and utilities, then they know the money's been used for a permitted purpose. That sort of takes that issue off the table. It also makes it easier to document the payments that were made. Now, we're not saying that the borrower needs to make their payroll, for example, out of that special account with the PPP, but they can use that account to fund or repay the operating account after they make the payroll from that account. In terms of documentation, documentation is largely what we thought before, except they do want proof of, they're going to want the 941s, the payroll tax filings, the state income, payroll and unemployment filings. They want proof of the payments, your canceled checks, payment receipts, transcripts of accounts. They also want proof that the mortgage, the rent, and the utilities have been in place on February 15th. So you're going to want that February statement. And then, as we talked about, the lender has 60 days in which to complete the review process. Turn to the next slide, please.
Hey, Dan, just a quick question before we move on there.
Yep.
The forgivable expenses, I know there's been a lot of questions with mortgage interest and utilities. For a while there, it was the thought that it could be any interest that the entity pays would be a overhead item, but that's not the case, correct? Is it just mortgage interest on real property?
No, see, it's mortgage interest on real property and it's mortgage interest on personal property. When you look at the definition of a covered mortgage obligation, they key the definition, and it's somewhat strange, off the whether a lien is filed on the assets that were used. So if there is a mortgage filed on real estate, for example, then it's a permissible covered mortgage obligation for which forgiveness can be obtained for the interest piece. Similarly, for a working capital loan, if the bank filed a UCC1, which is typically the way they take put a lien on personal property, if the bank filed a UCC1, then that also is a covered mortgage obligation, and the interest is a forgivable amount. So it can be for real or personal property, as long as a lien was filed. I think what they're trying to eliminate with the requirement for the lien was related party financing. And so if your mother loaned you money but didn't take against your assets, but didn't take a lien or didn't put a lien on the real estate, they didn't want that to be a forgivable expense.
Okay, that makes sense. But
yeah.
The other question I had too is, you get the question about, what is utility expenses and what exactly is covered under utilities?
Yeah, so if you look on the bottom right, all the way to the right, that column is forgivable expenses, right, during the 8-week period. And if you look down to the bottom on business utilities, the third row from the bottom, row 4.
All right, jumping up a little bit.
Yeah. No, it's good. This chart, I wasn't going to walk through the whole chart anyway, but this is a handy reference chart, I think, if people keep handy. On the left column, it shows the allowable uses during the 2-year period of the loan. And on the right, it shows what expenses are forgivable during the 8-week period. And we just wanted to highlight the difference here for people so they know what they're permitted to use, the allowable uses are, so they don't buy furniture or go on vacations, which should not be allowable uses. And on the right, the forgivable expenses. So to get to your question, we go down the business utilities on row 4, and we see that it includes electricity, gas, water, transportation, telephone, and internet, as long as those services were in effect before February 15th. The transportation issue, no one knew what that meant. It was very unclear. And when you look at, I think it was IFR 2 or 3, meaning interim final rule, the second or the third one issued by the SBA in relation to the PPP program, they talked about a leased automobile, and they talked about the gas expenses for that leased automobile. So the expenses of using that car are what they meant in transportation expense. So electric, gas, and water, we know what they are. Telephone, we get a lot of questions about landline, cell phone. Both seem to be included. There's no limitation. And same internet is what it is, internet.
Yeah, I guess a lot of our restaurant clients, they all have, cable, right, for televisions and stuff. So I guess I'm assuming that that's included.
Correct, exactly.
Okay.
And so this chart, I'm not going to go through it, but this is helpful, I think, for people to, I get a lot of, everyone asks for this chart, the slides, because they want this chart. So I thought I'd just put it in here for people to have. I think we can go to the next slide, which is a general question. Oh, the HEROES Act, right. So the HEROES Act was passed by the House on Friday, and is a $3 trillion stimulus package, which is objectively large, but also significantly larger than the CARES Act, which was 2.2 trillion. This was the Democrats essentially passed this this bill. They had no input from the Republicans. Even many Democrats were balking at the size of this program. So it's really, I think the better way to view this large piece of legislation is as an opening point in the discussion, and certainly not going to be passed in its present form. Republicans have announced it's dead on arrival. I mentioned that it's 1,800 pages in length, not to suggest that that won't limit its passage, but that the summary here doesn't do it justice. And so, we're just trying to put some relevant things here. The key, which are the changes to the PPP. So the proposals would extend the 8-week period to 24 weeks, eliminate that 75-25 rule that the SBA imposed on the program, but is not in the statute. Extend the maturity of the loan from 2 to 5 years. And recall, it is a 2-year loan, but the forgiveness period is 8 weeks. But a lot of people focus on the 8 weeks, but forget that it's a 2-year loan. It would create a safe harbor for borrowers who can't rehire in certain time frame, and would expand the eligibility beyond 501c3 organizations and to all 501c entities to make it broader applicability. There have been some rulings for special rules for hospitals and electric co-ops, but this proposal would expand it much more broadly. So I didn't want to focus too much on the HEROES Act, given it's not likely to be passed in its present form. It really is just a starting point in the legislative process. So with that, I'll turn it for, I guess we'll open it to questions and see what's on people's minds.
Mm-hmm. So, Alana, how are those questions coming through?
Glenn, so Jessica forwarded them to the group, so you guys have to look at your email if you just came in.
Okay.
I see the first one's not directed to me, I think. Mary Lou, this might be you. Any opening tips for banquet halls, for birthday parties and weddings?
Yeah, I mean, that's going to happen probably in phase 3, because that would be indoor. We actually have a call with the governor's office with the large venues in the state at 4 o'clock today to discuss those issues, because, obviously they have their own particular set of challenges. Obviously, if you have outdoor space, anything you can use in that way, I think is going to be helpful to you, tents, things like that, if you have that ability. If not, unfortunately, you'll probably be in that 3rd phase, or you'll be dealing at reduced capacity. That doesn't really work for weddings so much, because if you were going to invite 300 people to your wedding, you don't want to be told now you have to invite 150 people. But
also, that would make the dancing very awkward at social distance dancing.
Yeah. You could say you're going to social distance, but after a few times, I see people social distancing. So, but it may be easier at more of a, like I think it was birthday parties or something like that, where you can maybe just tell people, I'm sorry, you're going to have 25, 50%. So that's where they are. But I would certainly see if there's any way you can look at outdoor seating as something, or obviously reduce capacity.
Mm-hmm. So thank you for that. Question came in here about any update on CAM. I assume they're talking about common area maintenance charges in a lease agreement. So if there's common areas, the lessor typically passes those costs on to the borrower. We believe that those are included in rent. Usually when you look at those rent agreements, they define rent to include many items such as property taxes, common area maintenance charges, and other items. So as long as it's included in that additional rent in the rental agreement, we believe it'll be covered in the definition of rent for purposes of the forgiveness. But no guidance has been provided on that, but it's a common understanding and meaning of the term rent, so we believe it would be included. Next question here is, must you only hire original employees or can you hire new employees? And this is a very good question. This gets at the, I think, also gets at the interaction. You can hire new employees. You're not required to hire the original employees. And I think what really cemented this was the application that just came out this past Friday, and the interaction between the headcount rule and the wage rule, the headcount reduction rule and the wage reduction rule. And so it was unclear prior to this if you had to apply both when someone left the firm. So the way they're written, let's say an employee leaves and he's not in the covered period, you have a reduction in FTE because you had an employee in the base period but not in the covered period. So that would be one FTE reduction, and you'd suffer a reduction in forgiveness based on that. But also when you look at the wage rule, that person's wage went from 100% to 0%. So there would also be a reduction of wages in excess of 25%, notably 75%. So the fear was that they would interpret these rules in a way that where one employee doesn't come back, there's a 175% reduction of their wages in the forgiveness amount. And we thought that was punitive. We thought it was remote. And when we did calculations for clients, we put it on there as a worst case scenario, and then we said it was remote. And luckily, we've been proved correct. And in the application that came out, the way they didn't announce this, but it's inherent in the calculations. And so when you look at the way they calculate the wage reduction rule, it only applies to employees who are working during the 8-week period. So if they're not there because they were fired or let go or left and didn't come back, you don't have to factor in the wage reduction, just the headcount reduction. If they were replaced, you have a new FTE, so there's no reduction in headcount because you have another body there. So you eliminated it, and there's no wage reduction because, as I said, the only employees that are employed during the covered period have the wage reduction issue. So there's no penalty for hiring a new employee as opposed to the original employee. So that's a very helpful piece of advice that came out, and particularly since we have those four safe harbors, if we call them, that are out there about employees who voluntarily resign or fired for cause, request reduced hours, or you lay them off and they don't come back because they're making more on unemployment. Those also do not count against the borrower or the employer. Hopefully that answers that question. I see a few more here. It says, I presume rent is covered. What documentation do you need to prove that the employee didn't agree to come back? Okay, two good questions. Rent is covered. That was in that chart. It's both an allowable use and a forgivable expense. If the rent agreement was in place before February 15th, it's a forgivable expense, the rent. The way it's worded too is assuming you don't bump up to against the 25% limit of overhead expenses, including rent, you can deduct up to 3 months rent. If you pay monthly and you pay if the first month's rent is paid on the first day of your covered period, then you pay 2 more rental payments in the 8-week period, you have 3 payments, and those would seem to be covered. Nothing limits it to 2. I think the intent was to limit it to 2, but that's not what the application allows for. We don't know if that's an error or whether that's something they intended to be more generous in the forgiveness process, but it does seem to allow for that. So we are mentioning that to people. We're not encouraging you to plan into it, but we're mentioning it. There are some businesses that we have clients that are very low overhead businesses, and they're concerned they're not going to be able to use up their 25% overhead allotment. So if you're in that situation, this might be a way to get people into that closer to that 25%, so they get more forgiveness. The next question is, what documentation do you need to prove the employee didn't agree to come back? They never said. This goes to that FAQ number, I think it was 40. It was in the slide though, a couple slides back. But I think what they just said there, that the employee doesn't refuses the job offer and the employer documents it. So ideally, the employee, you send them a written communication, the employee writes back in writing, I'm not coming back, and there's your proof right there. Most likely that's not going to happen. I think it's going to be one of two things. You're going to have a phone call with them. They call you up and say, I'm not coming back, in which case the employer just has to document the phone call. There's no requirement to record it or anything like that. And even more likely is I think the employee, you just won't hear from them again. And they're not going to call you, and you may call them once or twice and they don't respond. In that case, again, we don't know what proof will be required, but what makes sense in that situation is probably just to document that you reached out to them. You sent them a letter, they didn't respond, so you tried to reach out 1 or 2 additional times, either in writing or by email or telephone in some capacity, and they didn't respond. It seems reasonable to conclude that's a rejection of your offer. They haven't said that, and so it's unclear whether they'll interpret it that way, but that would certainly be a reasonable position to take if you don't hear back and made multiple attempts to reach out to the person. Next question deals with 1099 contractor payments. Are they covered under the PPP? The answer is no. Independent contractors can apply for their own PPP loan, but they're not covered by the payor, the employer here. If you're paying 1099s to people, they're not covered, and it's not considered a payroll cost, so you cannot get forgiveness for that. The individual or company that's getting 1099 has to go then file for their own PPP loan. They would be covered in that capacity. Next one, last question here in this email is, must all of the loan amount have been spent during the 8-week period to be forgiven? The answer is yes and no. We look to the amount spent during the 8-week period. It's paid or incurred. So it does cover amounts paid, even if it includes pre-covered period amounts, as long as it's paid during the 8-week period, except for the back end. It doesn't allow you to prepay, say, 1 year of rent. You can't prepay, or you can't prepay your payroll expenses. The one exception is that rule that says if you make a payment in the ordinary course after the end of the 8-week period, but it includes some of the 8-week period, then that amount that is in the 8-week period can be forgiven under the forgiveness program. So that's the one exception. Think of it as it's a cash basis rule, except for that exception on the back end, where that little piece can be paid after the 8-week period. If it's an ordinary course payment, and then only the part of it that relates to the 8-week period would be included.
So Dan, what about unused loan proceeds? So I guess at some point you calculate the forgiveness piece, and the remaining unused portion just becomes a loan payable over 2 years.
Correct. It's a loan payable over 2 years, and we just have to remember that chart of allowable uses. Even though the forgiveness period is over, and it may be extended, so there's always a possibility of that, it cannot be used still on excessive. Well, it can be used on compensation that's not forgiven, but it cannot be used on furniture, for example. It can't be used on vacations. Can't be used to buy out a shareholder. There are permissible allowable uses, and it has to be one of those allowable uses.
Okay.
Next question here I see is, what is the definition of the base period? I assume they're talking about the headcount reduction rule and the wage reduction rule. I'll discuss both. On the headcount reduction rule, we talked about it. It was mid-February to end of June 19, or at the borrower's election, January and February of 2020. For the wage reduction rule, this was clarified in the application that it is January through March of 2020 is the base period, the 3-month period. And the statute had just said most recent quarter is what it said. So it wasn't clear if that meant, February, March, April, if you're talking about May or something, or if it was a calendar quarter. So the application interprets it as January to March of 2020. So that's clear. And then they also fixed there was a quirk in the wage reduction rule, because you're comparing 3 months of payments, January to March of 2020, to 8 weeks of payments in the covered period. And almost by definition, you're going to have a reduction. If you look at total wages, which is what the statute says, total wages during even if you keep payroll constant, if you pay somebody 3 months of wages and then compare that to 8 weeks of wages, you're going to have a reduction of 33% about. So there was a concern that you have an automatic wage reduction just by virtue of the calculation. And so they fixed that in the application as well. And what they do is they take they annualize the salary and then multiply it by, you annualize during the base period of 3 months, you annualize it during the 8-week period, and then that's how you compare them based on an annualized method. So you're comparing apples to apples. Next question here is under PPP, forgiveness expenses with regard to transportation that would include tolls on the roads or costs of an expressway pass to pay tolls. That's a good question. I think that would be covered under transportation. Again, just because the SBA gave an example of gasoline for an automobile doesn't mean that it's limited to that, and they never said it was limited to that. So I think that's a valid transportation expense, and I would argue that's included.
Hey, Dan, I'm not sure you saw this other question, which is apropos according, with restaurants, with tipped employees. So how do you pay an employee who was, tipped in the prior period? They made $1,000 a week, but now there's no sales. You bring that person back. Do you pay them assuming that they earn the same amount of tips?
That's a good question, and there's absolutely no guidance on this, but let me tell you what we think the answer is. So tips are included in the definition of payroll costs. So it was included in determining the loan amount. The tips that the employees receive should have been included. If that's the case, that amount is there for the employer to pay the employees. So they would pay them a tip amount based on the 2019 figures they included to determine the loan amount. And again, there's no penalty to the employer for doing that. In fact, they're encouraged to do that, because the more they pay their employees of that amount, the more headroom they have to put their overhead expenses in there. So, the employers are incentivized. The more they pay, the more overhead they have forgiven. So I think that's how you would calculate the tip amounts. It's part of payroll costs. If it's in the loan amount, the money's there to pay them, and it should be paid out that way through salary expense.
Yep, that makes sense.
There's 2 more questions here I see. Let's see, if I rehire an employee 4 weeks into my covered period, are required to pay the back pay for the 4 weeks? The answer is no, you're not required to. You're not required to do anything with the PPP money, really, except only use it on an allowable use. So let's talk about what happens, though, if you were to do that. So let's start, you pay the employee 4 weeks, you bring them back 4 weeks into the covered period, and then pay them for 4 weeks. So in the FTE calculation for the reduction the headcount calculation, you look at the number average weekly FTEs. Well, so this person was 1 FTE. They're going to count as 1 FTE from the base period because they worked for you back in 2019, let's say, if that's the period you're using. And then when you look at the 8-week period, each week you're going to average those 8 weeks. So the first 4 weeks you're going to have a 0, right? Because they were not working. And the last 4 weeks you're going to have a 1 for 1 FTE if they're assuming they're full time. So when you average them out, it comes out to 0.5. So for these regards to this 1 employee, you go from 1 in your base period to 0.5 in your covered period, and you have a reduction of 50%. So you'll have a reduction of proportion. If it's 1 employee over 19, you'll have a 5% reduction in your forgiveness amount. If it's 1 out of 100, you'll have a 1% reduction. But so there will be a reduction, a headcount reduction based upon this schedule of hiring this employee. but there would not be a wage reduction because as long as the annualized wage is still at least 75% of the prior wage, there's no wage reduction. There's no double punishment here. But there would be a reduction on the headcount basis, given you're going to have, again, 4 zeros for the first 4 weeks and then 4 ones for the next 4. Next question I see here is the problem with making the timeline end before unemployment is a loss of good workers. That's correct. The observation here is that people are getting unemployment, and by making them come back to work before that or come back on the payroll, even though the restaurant's not open, you're punishing the employee who could be making more, and that's correct. And by virtue of the fact that you make the offer, renders the employee ineligible for unemployment. So that's something also to think about. This gets at a good question that Glenn and I were talking about before the this webinar began, and that's, you know, in the restaurant industry, it's somewhat of a shame because you're forced to have this fixed 8-week period, and even though the restaurant's not open, and so you're paying the employees to stay home and watch Netflix, whereas other industries, they're getting the PPP money and they're paying their employees to work and generating revenue. Granted, they have a slightly bigger tax problem that we talked about a few minutes ago, and they'll have to pay more income tax, but that's a, you know, high-class problem, so to speak, right? At least you're making money. You have a tax obligation. So unfortunately, as of now anyway, you cannot change the 8-week period other than through that alternative payroll covered period we talked about earlier to align your, I don't think I mentioned that actually, to align your pay period with your covered period. You can change, there's an alternative period, which is part of the application process, is explained in there. And but unfortunately, there's no way to change the 8-week period. Now, legislatively, there's talk about passing something for the restaurant industry and some kind of additional relief for the restaurant and hospitality industries because they're so they're impacted so greatly. And so maybe when they come out with additional guidance, they extend that 8-week period. Maybe they delay it. I know it's not much help because you have to pay people now based on your 8-week period. But there may be some additional relief coming for the restaurant industry and or hospitality industries. Hopefully there is.
Okay, so I don't know if we want to, I mean, I guess there's a few more questions, Dan. I don't know if we're limited to. Okay, why don't we do that and then we can wrap up.
Okay, so the next question is, can a relative be hired as a new employee? Yes, nothing prohibits it. We are cautioning against, you know, we get these questions, can I hire my 7-year-old daughter? The answer is no, right? If you're audited on this, keep in mind you're making a statement under oath to a lending institution. The way I explain it to people is if you feel comfortable being audited by the SBA, sitting across the table from an inspector general, the SBA, and explaining how and why you paid your relative to work for you, then you should go ahead and hire them. If you think that would be an uncomfortable discussion to have and or subject you to penalties because they've never worked in your industry, they're young and inexperienced, or they have a full-time job elsewhere, maybe you should consider not hiring that person. You do have to put their social security number on the borrower worksheet. Now that's not submitted to the lender, but you do have to save that for 6 years. So that's how they could figure out who your employees are and that you're paying your relative. There is a next question is if rent has been prepaid before the cover period, is it allowed for forgiveness? Unfortunately not. If rent was prepaid before the covered period, it's definitely not included. And that will be a problem because then it's harder to get rent paid during the covered period. The only thing I can say in that situation is try and see if you can negotiate something with your landlord to maybe get a refund and repay it or something. I don't know. That's a tough situation. The next one is, I received a $100,000 PPP loan due to limited staffing. I can only spend $40,000. If I give the unused $60,000 back to the bank, can the forgiveness calc be adjusted based on 40 instead of 100? The answer is, well, yes and no. Yes, in that they I hate to keep saying that, but they came out with a rule that's helpful that you don't need to spend 75% of the loan on payroll. Originally, there was this thought that there was a cliff effect. If you didn't spend 75%, you get no forgiveness. So that's been clarified that it's clear you don't have to spend the full, even 75% of the loan on payroll. However, if you only spent 40,000 on payroll, unless you're within one of those 4 exceptions we talked about, you're going to have a headcount reduction. If you didn't bring back your people and you don't fit, they either didn't voluntarily resign to ask for less hours, you laid them off and they won't come back, or they you fired them for cause, then you have to include them in the FTE calc, and you're going to have a reduction. And the reduction would come on the reduction in forgiveness. Let's just say you brought back half your employees, and the other half didn't. You don't have a valid reason to exclude them from the calculation. You're going to have a 50% reduction, which means of that 40,000 you spent, only 20,000 of it's forgivable, which is a real cost to the institution because now you're spending that money twice. And so this is why we encourage people to model out their forgiveness calculation, because the reductions in forgiveness don't start at the amount of the loan, they start at what you spent. And here, if you spent 40 and you'd have a 50% reduction to bring you down to 20, it would be a real eye opener. So we do recommend people plan for this forgiveness calculation. See, is there any more questions? I see one more, and then we'll wrap it up here, Tom.
That's good. Yep.
Let's see, if I was given 75,000 and used 30 for payroll and 10 for utilities, is that considered forgiven, or the unused balance can be returned? The answer is yes, subject to the reason why you only spend 30 on payroll, right? If you didn't bring someone back and you don't have a good reason to exclude them, again, there's going to be a headcount reduction. So that'll start, of the 40 you spent, the reduction will start from the 40 and reduce it maybe by half, by 60%, whatever your FTE reduction is. So not spending the full amount is a problem. And so you need to make sure you have a good reason not to have spent it. Otherwise, it's going to result in a cost. And the cost is that reduction in forgiveness. It's very important. Again, it comes off, the starting point is the amount you spent, then you reduce it by your reduction in forgiveness. So make sure that if you don't, first of all, you should be bringing everybody back, even if they're sitting, again, at home watching Netflix. The more you spend, the more your utilities can be included. So that example, they got a loan of 75, spent 30 on payroll, 10 on utilities. I like the question because they kept the ratio of 25%, 10 over 40 total spent is 25%. So they got the utility ratio right, but there's probably a reduction in forgiveness unless there's a reason why they didn't spend the rest. Think about it, if they had doubled their let's say they spent 60,000 on payroll, they could have had 15 of utilities. The rest of the loan, 15 could have been spent on utilities or rent or something that's the borrower's overhead. So the borrower really gave up money here, right? They could have filled up their overhead expenses to 25% of the full loan amount. And so in this example, I would think of this as, don't worry so much. There's a couple things. You want to worry about paying an amount that's not forgivable, but you also want to worry about leaving money on the table. And so if you're not spending the full amount, you're not maximizing your overhead forgiveness, which is dollars in the owner's pocket. So there's 2 sides that should be focused on in looking at these numbers.
Okay. Well, Dan, thank you. Mary Lou and Dan, thank you so much for your input and your knowledge here. It was greatly appreciated. You made a complex situation somewhat simple. A lot of rules here, and the rules are changing daily. We're here to help you all. Please reach out to us and we can help. We have a good team that can help with the forgiveness calculation if you need help. And we wish you lots of success in getting started again in your business, and hopefully everybody is back in business soon. So thank you very much and have a great day.
Thank you.
Thank you, everyone. Please remember to take a moment to complete the online survey after you exit the webinar. Also, we'll email out the recording and the slide deck tomorrow. Have a nice day, everyone.
Bye-bye.